Hello, I'm Mark McSweeney, Executive Director of the Association Societies Alliance. We are proud to partner with our member SAEs across the country and, of course, Jeff Tenenbaum to provide today's webinar, Paycheck Protection Program 2.0, Everything Associations Need to Know. Today's webinar is being recorded, and a link to the recording as well as the slide deck will be made available after the program concludes. During the presentation, feel free to ask questions in the question box, and we will address those as we can. Before we get started, I would like to quickly take advantage of this opportunity to remind you of our new real-time compensation benchmarking program, a 24/7, 365-day-a-year platform available through your local SAE that provides association executives with compensation and HR-related data, offering key benchmarking information for your important staffing decisions throughout the year. Check with your local Society of Association executives to learn more and start participating today. And with that, let's get to the reason you're here and introduce today's presenter. Jeff Tenenbaum is one of the nation's leading nonprofit attorneys and also is an accomplished author, lecturer, and commentator on nonprofit legal matters. As managing partner of the nationally recognized Washington, D.C.-based Tenenbaum Law Group, Jeff counsels his clients on the broad array of legal issues affecting trade and professional associations, charities, and other nonprofits. For 19 years, Jeff practiced law at the Venable Law Firm and chaired its nonprofit practice for most of that time. Among numerous other honors and awards, Jeff was the 2006 recipient of the American Bar Association's Outstanding Nonprofit Lawyer of the Year Award, and is one of only 5 lawyers in the prestigious U.S. Legal 500's Not-for-Profit Hall of Fame. Jeff is the author of the ASAE published book, Association Tax Compliance Guide, and currently serves as chair of the American Bar Association's Trade and Professional Association Subcommittee and on the ASAE Legal Advisory Council and Public Policy Committee. Please welcome Jeff Tenenbaum. Jeff?
Thank you, Mark, and good afternoon, everyone, and good morning to those of you in the West Coast. Welcome to our program today entitled Paycheck Protection Program 2.0, Everything Associations Need to Know. This is our agenda for today. We're going to talk about, we're going to try to get through this in about an hour. We budgeted an extra 15 minutes to make sure we can deal with all of your questions. And as Mark said, please feel free to pose questions throughout in the chat feature, and Mark will pose those questions to me as we go along. This is complicated stuff. We're going to be talking primarily about the Federal Paycheck Protection Program. It's a program that was created by Congress last year as part of the CARES Act initially, and was open primarily to small businesses and some others, and also eligibility was open to 501c3 organizations in the first iteration of the PPP, or Paycheck Protection Program. This year, the program has been reauthorized with additional funding by Congress and was signed into law at the very end of last year. And eligibility was expanded to include not only 501c3s, but 501c6 organizations. And a significant amount of additional funding was provided. So that's going to be the primary focus of today's discussion. We're going to talk about PPP eligibility for associations, both C3s and C6s, loan forgiveness rules, and a number of other issues relating to the program. And then toward the end, we're going to talk a little bit to some changes in the Federal Economic Injury Disaster Loan Program and its impact on associations, and the same with respect to the Federal Employee Retention Tax Credit Program. And finally, we're going to talk about some changes to the rules for federal charitable contribution tax deductibility. And we'll take more questions at the end, but we'll also take your questions throughout. So let's dive right in. A little bit of background here. So this law, which is part of a broader bill, which was not too creatively entitled the Consolidated Appropriations Act, 2021. The particular bill at issue was called the Economic Aid to Hard-Hit Small Businesses, Nonprofit, and Venues Act, signed into law on December 27th. The act reauthorizes lending under the Federal Paycheck Protection Program through March 31st, 2021. We'll talk about what that deadline means, and it is a successor to the CARES Act PPP program. $284.5 billion is made available, with $35 billion of that set aside for first-time borrowers, including C6s. That does not mean that C6s have a cap of only $35 billion that they could access. It just means that $35 billion is exclusively set aside for first-time borrowers. But as long as monies are available, C6s can tap into other portions of that pool of money. It is a first-come, first-served program. Loans are obtained through SBA-approved lenders, private lenders, banks, and other community financial institutions, and not through the SBA directly. Most associations are applying through their own banks, presuming their banks are offering these loans. The most important element of these loans and what makes this program so popular is that the loans are either fully or partially forgivable if certain conditions are met. So you don't have to pay the loans back if you meet certain conditions, and we'll certainly talk about what those are. And then there's some additional funding provided, $15 billion for live venues, independent movie theaters, and cultural institutions. And you see the rest there. So what are some key changes for 2021 compared to 2020 for PPP loans? First, borrowers can set the covered period of the loan or the end date of the loan to be anywhere between 8 and 24 weeks after the loan disbursement date. So what does that mean? It means that the funds that you obtain must be spent on eligible expenses during that covered period that you select. We'll talk more about that in a few minutes. So borrowers that reduce wage or employment levels, so total wages or total employment levels, like number of employees during the covered period, can lose loan forgiveness, either partially or fully, unless one of the safe harbors excludes those reductions. And I'll talk about that in a little bit. And then the expanded pool of expenses on which PPP loans can be spent, the proceeds can be spent, have been expanded a bit to include certain operations expenditures relating to software and cloud computing, certain property damage costs, certain supplier costs, and certain worker protection expenditures. But to receive loan forgiveness, at least 60% of the loan proceeds must be used on payroll costs. And that term has a very precise definition in the law. It means wages, employer-paid payroll taxes, paid leave, healthcare payments, including health insurance premiums, retirement plan contributions, and then group life, disability, dental, and vision insurance premiums. That's an addition that did not exist last year. Up to 40% can be used on those other eligible expenses. Some more key updates, as I mentioned earlier, and the reason why most of you are here is that PPP eligibility has been expanded to include most 501c6 organizations, and C3s are still eligible, and I'll talk about how that's going to work, or how that is working. The program has greater flexibility for seasonal employees, not really relevant to associations. And additional funding is available for entities that returned their original amount or did not receive the full amount for which they qualified. And then finally, the law introduces this new concept, which did not exist last year, of first draw loans versus second draw loans. So first draw loans includes both PPP loans that were received under the CARES Act and PPP loans that are received by first-time borrowers in 2021, such as C6 organizations. Whereas second draw loans means the second PPP loan received by a borrower. So in the tax-exempt world, that could only mean a 501c3 organization, at least most of the time. There actually were some C6s that essentially mistakenly qualified last year. They applied and they should not have been approved, but the applications and loans were approved. But that minor issue aside, second draw loans are generally only going to be available to 501c3 organizations. There is a technical distinction between the two. First draw loans, there's a maximum limit of $10 million for first draw loans versus $2 million for second draw loans. But for all intents and purposes, most associations are not going to get anywhere close to that limit. Some larger ones will, but most associations will not. And the loan amount will be, and I'll get into this more, essentially 2.5 times your average monthly payroll cost, or that maximum loan limit, whichever is less. So if it's your second time around, you're going to be subject to a lower limit if you're a large organization. Loans reopened on January 11th for community financial institutions first, and then the program was open to all participating lenders on January 18th and will remain open until March 31st. So what that means is that if you want to apply for a PPP loan, whether it's first or second draw, you have to submit your application to the bank before March 31st. But keep in mind, as I said earlier, the money is likely going to run out. And so you want to apply sooner rather than later. So what types of entities are eligible for first draw loans? So for one, this is designed for small businesses. So there is a 500 or fewer employee limit. That means full and part-time employees. Each of them counts as an employee for that limit. Again, for most associations, that's not going to be an issue. The rest of these are, you can see everything. I'm not going to walk through it all, but bottom line, C6s as well as C3s and C19s will qualify. And if any of you are in kind of the arts and cultural world, if you receive a grant under the what's called Save Our Stages program, which is designed to kind of help live music and arts venues, you would not be eligible for a PPP loan. Now, for 501c6s, there were these special rules written in designed to ensure that the C6 organizations that can qualify are smaller. So there's a kind of this sublimit for C6s. I mentioned that first draw loans generally you have to be 500 employees or fewer. For C6s, you have to have 300 employees or fewer. So again, for most associations, that's not an issue, but for some very large associations, if you have over 300 full and part-time employees, you would not qualify. And you cannot receive more, you cannot spend, essentially you can't spend more than 15% of your budget on lobbying. And your total lobbying expenses cannot exceed $1 million during the most recent tax year that ended prior to February 15th of last year. So that first part, which is not underlined for a reason, the reason is that most associations don't have like special assessments to fund lobbying. Lobbying just gets funded from membership dues and perhaps from other sources. So this concept of receipts from lobbying, while we don't have any guidance yet from the SBA on how they're going to interpret that, it doesn't seem to have much applicability to associations. Unless the SBA were to, for instance, take that non-deductibility percentage of your membership dues due to the lobbying tax law and say that that's the figure that they were going to interpret. That could be an issue. Again, shouldn't be a problem for most associations. But on the expense side, you can't spend more than 50% of your budget on lobbying. Again, right now, the law, this is all it says. There's no further guidance on what this means, on what the definition of lobbying is, on where do we look for that data. But there are some reports that we've heard that suggest that the SBA and Treasury Department, which are kind of jointly administering the program, are likely to be inclined to rely on Form 990 data for determining total lobbying expenses. So whatever numbers you report in the Form 990, which would be for C6 organizations, those under the lobbying tax law, I reference here the Internal Revenue Code 162E, that's where the lobbying tax law is located, the law that was enacted back in 1993. That's what you will likely utilize, and for purposes right now, that's what I would recommend you utilize to see whether your lobbying expenses exceed 15%. And I point this out only for those of you who might be close to those limits. For instance, the tax code definition for C6 organizations of what is lobbying and what is not is different from the Federal Lobbying Disclosure Act definitions of what's lobbying and what's not. And for some associations that might spend a lot of money on, say, administrative and executive branch lobbying, versus legislative lobbying, or that spend a lot of money on grassroots lobbying compared to direct legislative lobbying, that could make a big difference depending on which set of definitions we use, but it's likely going to be the tax code definition, which is legislative lobbying, grassroots lobbying, political campaign activities like funding a connected PAC, and certain very high level federal executive branch lobbying, basically lobbying a cabinet secretary, their deputies, and then officials that are in the various White House offices. And then there's that overall $1 million cap that if you spend more than $1 million on lobbying, you're not going to be eligible either. And then finally, you cannot be organized for the purpose of promoting or participating in a political campaign. And for most associations, that's not going to be an issue. And then there's this other prohibition that 501c6 sports leagues are not eligible for these loans. So for those of you in the association management company world, this has been a very hot button issue in the AMC world, and one where there is a lot of uncertainty and lack of clarity. Now, and I know a number of you guys either work for AMCs or are involved in associations that are managed by AMCs. In an AMC model, as you know, the association doesn't have its own direct employees. It contracts with the association management company to provide management services, and the employees are employed by the management company. So the management company, assuming it otherwise meets the requirements, which most of them do, have less than 500 employees and whatnot, were actually eligible for PPP loans last year, and many of them, probably most of them from what I gather, did apply and receive PPP loans as a for-profit company. Because most clients of AMCs are C6s, there are certainly a number that are C3s. And from what I have heard anecdotally, there were some C3 AMC clients that did apply for PPP loans last year and received them. Again, it doesn't mean that they necessarily should have or shouldn't have, but they did in fact receive them. But since most of them are C6s, this hasn't become an issue until this year. But last year, the SBA released 3 different sets of FAQs, frequently asked questions, with all sorts of detailed Q&As relating to kind of how to interpret the rules. And one of them, and at the end of my deck here, I have links to a whole bunch of resources, including this particular FAQ at issue. The FAQ referred to PEOs, professional employer organizations, or similar payroll providers. And it basically said that clients of PEOs and similar payroll providers can be eligible for PPP loans, even though those organizations, the employees are on the payroll of the PEO or other payroll provider. Now, this is probably too much detail, but for those of you in the AMC world, I know you're going to need it and appreciate it. There is a distinct difference between a PEO and an AMC, and that in a PEO situation, the employees are expressly joint employees or co-employees of both the PEO and the client of the PEO, whatever the entity is. They're expressly co-employees, joint employers, and they're both kind of equally liable for various actions. Where in the AMC model, most AMC contracts with their clients take the position that the employees are solely employees of the AMC, that the association client is not responsible for employment liabilities and whatnot, and there's often even an indemnification provision in there. So there is a structural difference there, but there is also an obvious similarity as well. And so the real question is, could an AMC, under this, because this is the only guidance we have right now, could an AMC take the position that it is analogous to a similar payroll provider like a PEO, and therefore take the position that its association clients, if they otherwise meet the requirements, could be eligible for a PPP loan? So as I say here in the third bullet point, it can be argued that an AMC is structurally analogous to a PEO or similar payroll provider, and that as such, the clients, the associations, could be eligible for PPP loans. And unless and until the SBA says otherwise, I believe that there's a good faith basis for this interpretation of the FAQ. That being said, is it an aggressive interpretation? Absolutely, no question about it. Is it the most conservative interpretation? Absolutely not. Is there some risk that a bank may look at an application and say, wait, I don't see any, the associations don't have any payroll. They don't have their own direct employees, so how can they possibly be eligible? We're going to find that out very shortly, because from my anecdotal understanding, there have been some AMC clients, C6s, that have applied for PPP loans. We're going to see pretty quickly how some of the banks deal with that, and the SBA may come out with some guidance one way or another at some point. But if you deal with this through your own attorney and you get comfortable with the fact that there is a good faith basis for this interpretation, not that there's not alternative interpretations, but if you come to that conclusion, then what you, the client, would want to do is get the information from the AMC as to the allocable amount of wages, employee benefits, and employer paid payroll taxes that are paid by the AMC and allocable to the association client for that time period at issue. You'd have to get some written statement from the AMC, and I know that some are already doing that. The last point I want to make here, and I'm going to move on, is that there is something in the FAQ at the end that says employees of the eligible borrower will not be considered employees of the eligible borrower's payroll provider or PEO. And what I interpret this to mean is that, and it makes perfect sense, you can't double dip the same wages. So, you can't say whatever wages are allocated to this particular AMC client, the AMC cannot also use those same wages as the basis for its own PPP application. You need to make sure that you're not double dipping any of those wages. Okay, moving on. First draw loans, eligibility criteria. Primary eligibility criteria is that you did not receive a PPP loan under the CARES Act, or you now qualify for an increase of the original loan amount because of some of the changes in the rules. Requesting an increase in the original PPP loan amount does not turn this into a second draw loan application. Again, you have to have 500 or fewer full or part-time employees. The applicant must have been in operation as of February 15th of last year. And you cannot hire new employees now to justify the need for a PPP loan. And then this is really important, and this applies for first and second draw loans. There's something that's referred to as the necessity test. So for first draw loans, kind of proving the necessity of the loan is a much looser standard than for second draw loans, where it's much more precise. But for first draw loans, and this is going to include most C6 organizations, you have to certify in good faith that the PPP loan is necessary. This is in quotes from the law. Specifically, before submitting a PPP application, all borrowers should review carefully the required certification that, quote, current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. That bolded statement is the key statement that you have to feel comfortable making. And whoever's signing this is signing it under penalty of perjury. So it's very important that you have to have suffered some material economic harm as a result of the pandemic. For most associations, that's not going to be hard to certify, but there are some, including some of our clients, that have they did better in 2020 than they did in 2019. And it would be extremely difficult and dangerous, frankly, for them to make such a certification. And then borrowers have to make the certification in good faith, taking into account their current business activity and their ability to access other sources of liquidity sufficient to support ongoing operations in a manner that is not significantly detrimental to the business. The only other thing I want to say on that is I got a lot of questions last year for our 501c3 clients that were applying as to, does that statement at the end mean that we have to tap into our reserves before we can make that certification? And while the SBA has never said anything expressly and definitively on that, we know that countless applicants for PPP loans that have significant reserves were never asked to or forced to tap into those reserves before being approved for a loan, which would certainly strongly suggest that you do not have to do that. So for second draw loans, as I said earlier, well, maybe I didn't say this earlier, there's a lower cap, so it's employers with 300 or fewer full or part-time employees versus 500 for first draw loans. And then the necessity test still applies, as you can see with the bottom bullet point. But in addition, we have this other more precise test, which is that you essentially have to show that you experienced a 25% reduction in revenues in any quarter of 2020 as compared to 2019. So you calculate it by comparing quarterly gross receipts for one quarter in 2020 with quarterly gross receipts for the same quarter in 2019. And you can pick any of the 4 quarters that you want. They have to be the calendar quarters. And you can, in terms of documentation to establish this reduction, you can use quarterly, either audited or unaudited financial statements, quarterly or monthly bank statements, or annual IRS information or tax returns. And alternatively, this is another way to do it. A borrower that was in operation for all 4 quarters of 2019 can submit copies of its IRS Form 990 that reflect a reduction in annual receipts of 25% or greater in 2020 compared to 2019. So, in a bottom line, you got to show that you have this significant reduction in revenues for either any of the 4 quarters, 2020 compared to 2019, or for the year as a whole. And then for smaller organizations, if your loan amount is $150,000 or less, you do not have to provide this documentation as part of the initial loan applications, initial second draw loan application, but you are going to have to provide it later before you seek loan forgiveness, or at the time you seek loan forgiveness, substantiating that same 25% reduction. And then in order to qualify for a second draw loan, the full amount of the first draw loan must have been spent on eligible expenses. Okay, these are, it's not relevant to most associations. These are some excluded entities that are not eligible for second draw loans. I just want to point out the end of the second bullet point there. If your organization has a Chinese resident on its board of directors, it would not be eligible for a second draw loan. You can take a look at most of the rest of these, but they're not going to apply to most of your organizations. Now, getting a little bit more into the nitty gritty here. How do you calculate that maximum loan amount for first draw loans? So for C6s, most of you are going to be doing first draw loans. So the maximum loan amount is the lesser of the below calculation or $10 million. The lesser of what's listed here or $10 million. So how do you calculate this amount? First, you look at aggregate payroll costs for all employees living in the US. So if they're living outside the US, you can't count them. For A, calendar year 2019, B, calendar year 2020, or C, the 1 year period before the date on which the first draw loan is made. And you select which of those 3 periods. So you're going to pick whichever of those 3 gives you the highest payroll costs for employees living in the US. Second thing you do is you subtract amounts for cash compensation in excess of $100,000. So for those of you that have employees that make in excess of $100,000, you can count their salaries up to $100,000, but any amount over that you have to exclude. Then you do the monthly average by taking the total and dividing it by 12. So you get what your monthly average monthly payroll costs are. And then you multiply that average monthly payroll cost number by 2.5. So it's, and then the last part's not going to be relevant to most. If you got a loan, an EIDL loan last year as a C6 organization, and you wanted to refinance that and roll it into the PPP loan, you can do that. But bottom line is, it's generally going to be 2.5 times your average monthly payroll costs for employees living in the US and excluding compensation over $100,000. For second draw loans, it's pretty much the same. Same calculation as I just went through for first draw loans, with the only difference being that lesser of the calculation or $10 million for the first draw loan, and a second draw, it's the lesser of that calculation or a $10 million cap. And then same thing, you get to choose that period for determining the total payroll cost for the year of 2019, 2020, or that 12-month period prior to when the loan is made. That's referred to as the reference period. So if you hear that term, that's what that means. And then for those of you part of a larger corporate group, businesses that are majority owned directly or indirectly by a common parent, there's a total overall limit of $4 million, but it's unclear if that applies to nonprofits. Okay, so that's how you calculate the loan amount. Now we're going to kind of get into what can you spend the money on if you want to be eligible for loan forgiveness. So these are the things that you can spend the money on. And remember what I said earlier, you have to spend at least 60% of the loan on payroll costs, which I defined earlier and I'll redefine here. And then you can spend up to 40% on these other costs. And this slide just gets into a little more detail on what that means. So the payroll costs include not just direct wages, but employee benefits, employer paid payroll taxes, paid leave, things like that. And I said earlier, the payroll cost definition was expanded to include group life, disability, dental, and vision insurance premiums. Now that other 40% can be spent on rent, covered mortgage interest, and utilities. That's the same as it was last year. But in addition, these last four bullet points are other things that you can also spend the money about. And the first 3 relate to COVID-related expenses that have been incurred to worker protection, facility modification, property damage costs. Well, I should say the first 2 bullet points there. The last 2 bullet points are broader, and this is more helpful. It's giving borrowers the ability to spend money on other things beyond what was just rent, covered mortgage, interest, and utilities. So expenditures to suppliers that are essential at the time of purchase to the recipient's current operations, that can be significant. And then lastly, covered operating expenses, which is payments for any business software or cloud computing service that facilitates business operations, product or service delivery, processing, payment, or tracking of payroll expenses, human resources, there's no other definition than that, sales and billing functions, or accounting or tracking of supplies, inventory, records, and expenses. Now, granted, if you're going to spend, all of the money, for instance, on, payroll costs and rent, then these other things don't matter. But if you would have trouble spending, the right percentages on those things, then it's helpful to have these additional things that you can spend the loan proceeds on. There is a prohibition on using any of the proceeds of a PPP loan for lobbying, and that's defined very precisely as lobbying activities as defined in the Federal Lobbying Disclosure Act. Also, lobbying expenditures related to a state or local election. And third, expenditures designed to influence the enactment of legislation, appropriations, regulation, administrative action, or executive order proposed or pending before Congress or any state government, state legislature, or local legislature or legislative body. So there is some overlap between the first bullet point there, the Lobbying Disclosure Act definition, and some of these other things. And frankly, the terminology they used in number 2 here really isn't accurate, because expenditures related to a state or local election are generally called political campaign expenses, not lobbying expenses. But neither here nor there. Essentially, don't use any of the proceeds for lobbying or political campaign expenses. Now, this is important, and I referred to this earlier. This covered period. So that's another defined term. Borrowers can choose the length of the covered period, ranging anywhere from 8 to 24 weeks, meaning that the funds that you receive have to be spent on eligible expenses during the covered period. Most associations are probably going to, pick an 8-week covered period, but if it takes you longer in order to spend that amount, because you want to get the maximum loan amount, obviously, if it takes you longer, you do your calculations, you can pick a longer period. These are 100% guaranteed by SBA, no collateral is required, no personal guarantees are required. If for some reason you don't get full loan forgiveness, the interest rate is only 1%, calculated on a non-compounding, non-adjustable basis, and it's a 5-year loan term. And all loans are processed by all lenders under delegated authority, and lenders are permitted to rely on certifications of the borrower to determine the borrower's eligibility and use of loan proceeds. Now, it's kind of doubling back on some of the things that I've already talked about. To qualify for full loan forgiveness, the top bullet point, this is the main thing to focus on. If during that 8 to 24 week covered period that you choose, employee and compensation levels are maintained, the loan proceeds are spent on payroll costs and other eligible expenses, which I've already defined, and at least 60% of the proceeds are spent on payroll costs, with the remaining 40% or less being spent on other eligible expenses. If all 3 of those things happen, then you can get the loan fully forgiven. But all 3 things have to happen. So to drill down a little deeper, and just to kind of refresh your memory here, at least 60% have to be spent on those payroll costs, which includes the things that are listed here: wages, payroll taxes, employer paid payroll taxes, paid leave, healthcare payments, retirement plan contributions, and group life, disability, dental, and vision insurance premiums. The other 40% spent on those other things that are listed there, which I've already gone over. And then finally, on that issue of employee and compensation levels being maintained, there are actually 2 safe harbors that allow some reduction in employee and compensation levels without losing full loan forgiveness. So this is helpful. For the first one, which is the second bullet point from the bottom, borrowers must attempt to keep the same number of employees to the extent possible. A reduction in over 25% of salaries will result in a commensurate reduction in overall loan forgiveness. But if the reduction is less than 25% of salaries, there's no reduction in loan forgiveness. So you still get full loan forgiveness as long as the total salaries were not reduced that year over year comparison, 2019 to 2020. More than 25%. And then the other safe harbor is that if a borrower cannot find employees to rehire, or the entity is shut down due to COVID, the borrower will have a safe harbor and not be penalized for a reduction in a headcount of greater than 25%. That's not going to apply to most associations, but the second to the last bullet point very much may for a lot of you, and that's very helpful. For those smaller organizations, that you should focus on this slide. That if you receive a loan of $150,000 or less, then at the time of your application, actually that's not entirely true. If it's under $50,000 or less, oh no, it is accurate. Sorry, I'm confusing myself. So at the time of your initial application, if it's $150,000 or less, you don't have to submit that documentation, to prove the financial hardship and whatnot. But you do have to provide it before the loan forgiveness application is submitted. But in terms of the requirements for loan forgiveness that I just went over in the prior slide, borrowers only need to provide a one-page certification that includes certification as to the number of employees that the borrower was able to retain because of the loan, the estimated total amount of the loan spent on payroll costs, and the total loan amount. And then in addition, you have to attest that you spent the loan on eligible expenses and that you will retain records to prove compliance with the PPP requirements. You need to retain employment records for 4 years, at least 4 years, and other records for at least 3 years. So you don't have to actually provide those records like other borrowers do for loans of greater than $150,000. But you do remain subject to audit, which could require documentation and result in a modification of the loan forgiveness amount. And then finally, as I said earlier, while not required as part of the initial loan application, you still need to provide documentation to the lender substantiating the 25% or greater reduction in gross receipts before you seek loan forgiveness. And that, I believe, is only for second draw loans, not for first draw loans. This is a slide focused on taxable businesses. So for those of you that are, for instance, from AMCs, you should take a look at this, but I'm not going to really talk about it right now. For most, it doesn't apply to tax exempt organizations. Okay. Finally, a few slides on some related programs which might be of benefit and interest in use if an organization qualifies. So many C6 organizations did apply for the economic injury disaster loans last year because they weren't eligible for PPP loans, but they were eligible for EIDL loans. An additional $20 billion was authorized for this program. However, these loans are not forgivable like PPP loans. EIDL loan applications are done directly with the SBA, not through a private lender. To qualify, you have to be located in a low-income community, have suffered an economic loss greater than 30%, and employ not more than 300 employees. That first requirement, and perhaps the second one too, are going to make it more difficult for and that did not, those first two requirements from what I recall did not exist in last year's EIDL program. And then like last year, you can basically get an advance of up to $10,000 that does not have to be repaid. And then the amount of the loan is essentially $1,000 per employee for up to 10 employees or $10,000. So that's how you calculate the amount of the advance. So if you had 4 employees, you could qualify for an advance of $4,000. If you had 10 or more employees, you can qualify for a $10,000 advance if you otherwise meet the qualification requirements. The loans carry a 3.75% interest rate with a 30-year term and automatic deferment of a year before monthly payments can begin. So not unfavorable. You can use the loan for working capital and operating expenses, a much broader pool of expenses you can spend the money on. To be eligible for the loan, you have to provide collateral for over $25,000. Collateral can be machinery and equipment, furniture, fixtures, and other things. That being said, I've been told by some clients and others that when they applied and received EIDL loans last year, they did not provide any collateral, even though the loans were over $25K. And I can't explain why, because that was a requirement last year as well, but I just throw that out there. And then most associations did not apply for loans over $200,000 because personal guarantees are required. And supposedly more guidance is going to be coming from SBA on this program. Now, the last main thing I want to talk about is the employee retention tax credit. Now, there's a significant change here. If you look at, so first off, I'm going to explain what this is. So the new law clarifies and expands the federal employee retention tax credit program. This applies to federal employer paid payroll taxes, specifically to the 6.2% employer paid Social Security payroll tax. It is applicable to associations and other nonprofits, even though you're exempt from paying corporate income tax. You're not exempt from paying employer paid payroll taxes on Social Security and the Social Security payroll tax. And so it does apply to associations. This is an important change. Last year, the ERTC and the PPP program were mutually exclusive. So if you got a PPP loan, you were not eligible to take advantage of the tax credit or vice versa. That has been changed now so that you can do both. So if you otherwise qualify, you can get a PPP loan and claim the ERTC. And this change is retroactive to March 12th of 2020, which is the effective date of the original CARES Act, meaning that employers that took PPP loans are now eligible to take the ERTC so long as the same wages are not used for both, meaning the tax credit cannot be claimed for wages paid with the proceeds of a PPP loan that have already been forgiven. Qualified wages are those paid after March 12th of last year and before July 1st of this year. And this is helpful. It's a refundable tax credit, meaning if the tax credit exceeds the payroll taxes due for that quarter, you can get a refund from the IRS of that amount. Now, this is where it's going to be a little trickier, the eligibility requirements. And it's a bit complicated, so bear with me. First off, there's two kind of alternative eligibility requirements. You see the or there at the end of the first bullet point. So the tax credit is available to employers with operations that are either fully or partially suspended by a COVID governmental order, and only during the period that the order is enforced. And partially suspended is defined as operations continuing but not at a normal capacity. Again, that may be difficult for a lot of associations in particular, as opposed to, say, restaurants or others. It may be difficult to be able to satisfy that requirement. The other way to qualify is if you sustain a significant decline in gross receipts. That's the basic criteria, and then it's defined very precisely. So for 2020, the definition of a significant decline means the first calendar quarter after December 31st of 2019, in which gross receipts are less than 50% of the amount in the corresponding prior year quarter, and ending with the next quarter, in which gross receipts exceed 80% of the corresponding prior year quarter. That's a mouthful, and trust me, it's taken me a while to get my arms around that with some help from some very talented CPAs. But essentially, you have to have a significant decline in revenue. And that's going to be difficult for some associations, but not all, to satisfy. For 2021, that eligibility has been expanded by reducing the required year-over-year gross receipts decline from 50% to 20%, and providing a safe harbor allowing the use of prior quarter gross receipts to determine eligibility. So it's going to be easier to meet the qualification for 2021. And it will be, and it may be that a number of you can qualify, and I know that a number of associations are very much considering taking advantage of this. And for tax-exempt organizations, the term gross receipts is defined to mean contributions, gifts, grants, dues, and assessments, sales and receipts from unrelated business activities, the sale of assets, and investment income. Eligible size, again, this should not be an issue. As of this year, the threshold increased to 500 full and part-time employees. It used to be 100. And when calculating the 500 employee threshold, the employees of all affiliated entities sharing common ownership are aggregated. Again, it's unclear whether nonprofits that exercise common control over affiliates would be covered, because the language just refers to ownership. And then in terms of what is the tax credit, how much is it worth? Beginning January 1st this year, the tax credit is 70% of qualified wages, plus the cost to continue providing health benefits to the employee. For 2020, the tax credit was 50% of qualified wages. So it's a significant amount and a significant potential benefit. And then the maximum amount of the credit that you can get, there is a cap. So for last year, March 12th through December 31st, the tax credit cap was $5,000 per employee. That's the calculation of how you get there. For this year, the tax credit cap is increased to $7,000 per employee for each of the first 2 quarters of 2021. So it's a possible $14,000 credit per employee. Again, nothing to sneeze at. And then the 2021 tax credit is available even if the employer received the $5,000 maximum credit for wages paid to those employees in 2020. And finally, wages used for the ERTC cannot be used to obtain PPP loan forgiveness. And then finally, second to last slide, the charitable contribution tax deduction. There were certain enhancements to the charitable tax deduction that were made in the CARES Act last year that have been continued for 2021. This is what they are. Non-itemizing taxpayers, if you don't itemize your tax returns, you can now deduct up to $300, $600 for a married couple filing jointly for contributions to C3 organizations. In addition, the law extends for 1 year the increased limits on deductible charitable contributions for individuals who itemize and for corporations. So for individuals, the cap is going to remain at 100% of adjusted gross income instead of reverting back to 60%. And for corporations, the annual limit will stay at 25% of taxable income instead of reverting back to 10%. So these are basically caps on, if you make a lot of charitable contributions, there's a cap on how much you can take, and then the rest gets rolled over to the following year. Those caps have been increased, and they will stay that way for this year. And then finally, the cap on charitable tax deductibility of food donations from corporations will stay at 25% of taxable income instead of reverting back to 15%. So again, for those of you that are C3 organizations and soliciting contributions from individuals or corporations, this is something that may be of interest, as well as those of you personally. And then, as I said earlier, I have included and I updated these over the last couple of days. These are all essentially, except for the last one, they're all from the SBA website. A lot of really helpful information here. First and second draw loan applications, the loan forgiveness application that you'll file at the end of the covered period, what they call the interim final rule for first and second draw PPP loans, as well as loan forgiveness. And then the FAQs for first and second draw loans, those are new. I included the FAQ regarding Association of Management Companies, and then the there's a kind of an overall link to all of the SBA COVID-related guidance and resources on their site, as well as the law itself. So that brings us to close to the end of our program, but I want to open it up for questions that any of you guys have.
All righty, Jeff, thank you very much. We actually do have a handful of questions here, most of which are looking for some clarification on some things, but we'll just start from the top. For a C6, if the organization has access to other funds, either reserves or could obtain their funding from a lending institution, does the organization still qualify to apply for PPP?
Yeah, as far as we can tell, especially based on last year's PPP history, yes, even if you can qualify for say a commercial loan, or even if you have reserves in the bank and investments that you could tap into, there's been no either guidance from SBA suggesting that you have to take advantage of that first before you can qualify. And there have been countless thousands of organizations, actually tens of thousands, maybe even hundreds of thousands, I don't know the actual numbers, of organizations that had both access to commercial credit as well as plenty of reserves that did qualify and were not forced at all to tap into this. So as far as we can tell, and unless and until we hear otherwise, and that's partly with new programs like this, there are always going to be some open questions, unanswered questions, but there's nothing to suggest that you would not qualify right now.
Okay, if our organization was able to transition to virtual, meaning all of our employees were able to work from home and also our events were moved to a virtual platform, do we meet the definition of full or partial shutdown?
So that definition of full, let me go back to that, of full or partial shutdown was only for the ERTC, just to clarify that. It's that fully or partially suspended. There's no such requirement for the PPP program. So if the questioner is only worried about or thinking about PPP loan application, don't worry about this. That's not a standard that applies to the PPP program. This is only for the ERTC, and it's one of the two alternative ways that you can qualify for the ERTC. But that's why I said for most associations were able to convert to a fully virtual workforce during COVID. they likely would not meet that first eligibility requirement for the ERTC. It's almost impossible to imagine how that would be the case for most associations. There can always be exceptions.
Looking for some guidance on the authorized representative requirement. So with no quote unquote owners, we are putting staff or volunteer SSN in the application. How did C3 organizations handle this in the first round?
So, wait, first off, is this a first draw or a second draw loan?
Just references first round, so assume first.
Okay, so there is a question. I know it's in the second draw application. It might be in the first as well, about who the owners are of the organization. And obviously, as a nonprofit organization, there are no owners. I've gotten that question from a number of folks, and I know from a number of folks who have applied, they just left that blank. From what they told me, I've not actually done a loan application myself, but I've seen the form. What they've told me is there's no place where you can actually put NA, not applicable there, but they've just left that blank and noted that somewhere else in the application. But I think the questioner, if I'm not misunderstanding, is talking about who's authorized to sign the application. Is that the question?
It's just asking how the C3s handled it in the first round, since there are no owners.
Yeah. So for the question about who owns it, just leave it blank. At the end, whoever's submitting the application, it has to be an officer of the organization. And obviously C3s have officers, as do C6s.
And Jeff, she came back and did clarify a little bit. She said, actually, I can't get through the application without putting someone's social security number on the application online.
So, and that's not uncommon for the person who is submitting the application, who's signing it on, on behalf of the organization, whoever that officer is. And I mean, like, for instance, we have to do that for EIN applications, employer identification number, whenever we form new entities. We have to put whoever's signing and certifying the application, the Form SS4, has to put their social security number there. That's not an uncommon requirement. That is not subject to public disclosure. But I don't believe there's any way around that, but I really don't have any other insight, unfortunately, at this point on that.
Okay, thank you. What if your bank doesn't list 501c6 as an option in the dropdown? Is that something that they need to add, or should we select something else?
Yeah, so this happened last year too. This is all brand new for the banks. There's been changes. They're using their stuff from last year, which had C3s but not C6s. And I've heard things like this that banks haven't updated. Like the SBA has their own version of the loan application. Some banks are using that. Others are kind of creating their own based on that. And they may not have updated to create an option, a drop-down option for C6s. And if that's the case, you should contact your bank and ask them to update that so you can, apply under the right category for sure.
Great. For the 25% reduction in gross receipts test, how are gross receipts defined? Is it a cash basis based on how revenue is recorded in your financials? How's it defined?
Yeah, I just had a conversation with a CPA who I'm doing a presentation on this with on Friday for ASAE, and what he told me, and I'm glad we talked about it, because I am not an accountant, and that is not kind of in my bailiwick. The definition of gross receipts was here somewhere, but anyway, he told me to basically use the data that you use for the Form 990. He got into a lot more detail about it, which I didn't quite grasp all of that, but he said whether you're a cash or accrual basis, use the numbers that you use for your Form 990. And I fortunately, I don't have any more detail on that.
Okay. If one of your employees lobbies on behalf of a C6, would a portion of his or her wages be excluded for PPP loan usage?
Okay, this is interesting. Let me go back to that slide about probate. Here we go. So no proceeds can be used for lobbying. So yeah, and using it for lobbying would also include staff salaries for sure. So you have the front end calculation of your loan amount. And for that, you would be able to include the salaries of employees, say, who are in your government affairs department, public policy department, that are spend their time lobbying. So this is how you calculate the loan amount. There's nothing that says you have to exclude amounts that are for employees that spend time lobbying. So to calculate the loan amount, the lobbying is irrelevant, unless you're an organization that overall doesn't qualify because you spend more than 15% of your money on lobbying, or you spend more than $1 million a year on lobbying. But once you get the loan amount, 2.5 times the average monthly payroll cost, then in terms of the back end and what you can spend the money on, by the way, this is a prohibition that's not just about loan forgiveness, it's just a broad prohibition. So you would not be able to use the proceeds to essentially subsidize the salaries and time of anyone who is engaged in these sorts of lobbying activities on your association staff.
All right, this one, there's a fair bit of background here before we get to the question, but 80% of our revenues come from our annual conference in January. We were able to hold the conference in January of 2020, but we cannot hold it in January of 2021. While we keep our books and file our tax return on an accrual basis, our cash receipts through 2020 were substantially below 2019 because we collect the cash for our conference starting in April prior to the conference. It therefore makes sense for us to compare receipts in 2020 versus 2019 on a cash basis. Receipts can be substantiated by our bank statements, but will not tie to our audited statements or tax return. Here's the question. Is it acceptable to file for a PPP loan on the basis of the decline in cash receipts, even though our accounting is completed on an accrual basis, as the negative impact of the pandemic on an accrual basis will not be evident until Q1 of 2021, when we are not able to hold our annual conference?
It's a great question, and unfortunately, because because I'm not an accountant, and B, because I don't believe, from what I heard, that SBA has issued the statute, and neither SBA has issued any guidance on this. There's nothing on this in the interim final rule. I don't believe I have an answer for you, but one thing to keep in mind, that's a requirement only for second draw loans. So if you're a C6 and doing a first draw loan, this 25% revenue reduction rule doesn't apply. It's irrelevant. You just have the general necessity test. And certainly that example would, to me, clearly meet the necessity test. So maybe that helps to answer your question. But if you are talking about a second draw loan, it's certainly a good argument to be made, but I don't know whether that would fly or not. And I don't know that anyone's going to be able to tell you, but feel free to join the ASCE webinar on Friday and pose that question. The accountant, not to me.
This is similar to the previous C6 lobbying question, but do we need to segment out each employee's time spent on lobbying to calculate their average percentage of applicable PPP loan wage subsidization? For example, if one of my employees have 15% of their job description focused on state and federal direct lobbying activities, can I apply up to 85% of their wage toward the loan amount received?
Okay, so again, just to refresh what I said earlier, when you're calculating the loan amount, 2.5 times your average monthly payroll costs for employees living in the US and excluding wages over $100,000, whether any of those employees spend time on lobbying is not relevant. That's fine. You can include those. But then when it comes to what you spend the money on and this very strict prohibition, and there were some senators in particular that really pushed hard for this, I believe Mark Rubio and others, you cannot spend it on lobbying. So if an employee, based on your time sheets that you keep for lobbying tax purposes, lobbying disclosure purposes, or whatever other purposes, that employee spends 15% of his or her time on lobbying and 85% on non-lobbying activities. And by the way, lobbying as defined by this slide, which is in some cases going to be a broader definition than you may be using for IRS Form 990 purposes. under the lobbying tax law. Just keep that in mind, because the Federal Lobbying Disclosure Act has a much broader definition of federal administrative lobbying, as does all of this here, compared to the lobbying tax law definition. But that aside, if you can figure out the definition, it's going to be really complicated in that regard for some associations. But yes, in that, let's just say you agree on the definition of lobbying, that employee spends 15% of his or her time on lobbying. You should be able to use the loan proceeds to, cover 85% of his or her salary and employee benefits and everything else, as long as you exclude the 15%. And you're going to want to keep documentation of that. Because I'm not clear, I don't typically go through that whole bank loan forgiveness application process with clients. I don't know exactly what is required to be provided in documentation and whether that level of documentation would be required, but it certainly could be required if you get audited later. And there were a lot of audits that have occurred from 2020 PPP loans. And so you're going to want to keep good documentation to be able to substantiate that.
For EIDL, is the threshold 300 persons employed or 300 full-time equivalents?
So it's the same as for the loan limits for PPP loans. It's 300. Let me find the for EIDLs. I believe
Yes.
it's. Where is that? I believe it's the same. It's. Oh, you're right. You know what? I'm not absolutely sure. I'd have to go back and look at the guidance. It just refers to 300 employees. I know that for PPP and for the employee retention tax credit, the law is very clear that it's not full-time equivalents. It's full-time and part-time employees. Each one is counted as a separate employee. If there's no other guidance in the law, then basic statutory construction principles would say to use the same definition. There might well be more specific guidance on that. If you look at the last slide with the resources, that this one down here at the bottom, EIDL loan application, look there, and there may also be there's no interim final rule as far as I know so far on the EIDL, but there may be some FAQs, particularly from last year on the SBA site. Go to the this one here, COVID-19 guidance and resources, and just look through there, and you likely would be able to find some guidance on that, hopefully.
Okay. How do employers apply for ERTC? Is it automatic, claimed on next year's IRS 990 form, or through filing quarterly payroll reports to the IRS? And are there any states that are also offering ERTC or a similar program?
I'm not aware of any states offering that. I believe, you know what, I had something on this in the article and PowerPoints I put together last year under the CARES Act. I think I had something on the mechanics of how you take advantage. I believe it's with the quarterly tax filings that you take advantage of it. I'm not 100% positive, but I believe that's the case.
Okay. Are there any concerns related to UBIT that 501c6 organizations should consider for accessing PPP, EIDL, or ERTC?
No, none at all.
Any reason?
By the way, other UBIT issues that, I'm actually working on an article right now for ASAE's magazine about UBIT issues in the face of the pandemic and how the pandemic has changed some issues on UBIT. So if you have an interest in those issues, keep an eye out for that, and we'll have that posted on our website once it's done. But nothing related to these programs.
No. Okay. Is there any reason not to use the 24-week period to justify PPP forgiveness so that they have available wages to justify the ERC credit?
Wait, can you repeat that, Mark?
Sure. Is there any reason to not use the 24-week period to justify PPP forgiveness? Looks like I'm missing a word here. So that we have available wages to justify ERC credit.
No, and that's a great question. That's the kind of calculation that you should do, to figure that out, right? There might be the pros and cons of each, right? If you use a longer period, you can't seek loan forgiveness until the end of the period, but that may be fine. It might not be a big deal to do that. But yeah, if you can spread it out, then there's going to be more wages that you can take advantage of under the ERTC so that you're not double dipping. And I can't think of any reason why you would not want to do that. That would make a lot of sense. Again,
Okay.
if you otherwise qualify for the ERTC.
At the end of 2020, we netted more profit than we did in 2019. We also never hit the 20% reduction in revenue during 2020. Should we still apply for the PPP funds?
Well, look, everyone has to make their own determination here about this necessity test. You have to certify that the loan is necessary and that current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. And I had discussions with a number of C3 organizations last year, particularly CFOs, and some of them just didn't feel comfortable making that certification. And they were also, frankly, this is before a lot of these Freedom of Information Act suits from the Washington Post and others secured the list of the names of PPP loan recipients. So you have to assume everything is going to become public here, just like a lot of it has from last year, at least for not all the smaller borrowers, but over a certain size, most of that became public, and there's been a lot of analysis about it. So you got to think about the political issues here, the public relations issues. If your organization did pretty well and actually made more money, and all that's shown on the Form 990, you're probably going to want to, just from that perspective, think hard. Never mind, from the legal perspective, and you're making a certification under penalty of perjury that you really need this loan money. That might, I would be very nervous about making it in that particular situation. That's all I can say. But you have to make your own determination.
All right. Well, it looks like you have hit on everything else already. Any other closing parting thoughts from Jeff?
Nope. This is, maybe a couple. First off, this is kind of a moving target, a work in progress, just like last year. We expect there will be continued guidance that comes out from SBA and Treasury. There will be on some issues, there won't be on others. So I was talking to some of the ASAE public policy staff earlier this week, and they think that SBA actually might not want to give any more guidance on the definition of lobbying activities and things like that. Well, we're just going to have to wait and see. But there certainly will be more guidance that comes out, perhaps on that association management company issue and whether their clients can qualify. But in the interim, there are going to be a number of open questions, and you need to consult with your own counsel, your accountants, and make your best good faith determinations about what you feel are the right interpretations and conclusions about any of those open questions, and keep an eye on guidance as it continues to come out. But this is a great program. Quite a number of my 501c3 clients took advantage of it last year, and it was extremely helpful in helping them keep people on the payroll, not have layoffs or furloughs or salary reductions, and hopefully it'll do the same thing for a lot of C6 organizations this year.
Fantastic. Thank you again very much, Jeff. Truly appreciate all of the insight as always. As a reminder to everyone, today's webinar has been recorded. So following the program, you'll receive a brief evaluation that we do encourage you to complete, as well as you'll receive a CAE credit certificate. And we will make the link to the recorded webinar from today available to you as well. Thank you all again for joining us. Please enjoy the rest of your day.